The world is going through changes. Changes happening at a speed that we have never seen before. This is leading to disruption, chaos, panic, fear, hysteria, and a turbulent economy and marketplace. How do you protect your wealth in a turbulent world? How do you invest for cash flow in alternative assets to escape the rat race in times of uncertainty? How do you decentralize yourself, your family, your community, your business, and your investments to become sovereign and escape the matrix? If you are looking for strategies, tactics, and techniques to escape the rat race and matrix, you are in the right place. My name is MC Lobsher, and this is Cashflow Ninja. This is Cashflow Ninja. I'm MC Lobsher. Thank you so much for joining me and spending your most valuable resource, your time, once again with me. Everything Cashflow Ninja is at cashflowninja.com. We have podcasts, we have books, reports, webinars, and much, much more. And don't forget to subscribe to the #1 newsletter in the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. I've got a fantastic show for you today. I have Justin Donald, the lifestyle investor, with me back on the show. Justin, it's great to see you.
Thanks, MC. It's great to be back.
Yes, been looking forward to this conversation. For our new listeners, Justin has been on the show before, and he always provides so much value. You will find great value from that conversation too. Just go to cashflowninja.com and type in Justin Donald, and you'll find our previous conversation. For our new listeners and viewers that's not familiar with you and what you do, could you give a brief overview just of your background and what you get up to?
Yeah, so I'm an investor at heart. I'm an entrepreneur at heart. So, I've built businesses, I've bought businesses, I've sold businesses. I really just want to get to a point where I didn't have to trade time for money. So that was my big thing, is like, how do I buy my time back so I can spend it exactly the way I want to? And so I found the first kind of step of that in the business world, but there was always something that kind of I was on the hook for. So I didn't feel like I could fully transition away from time equaling money. I think I did a good job of leveraging it. But once I figured out how to invest and I really allowed my capital to produce more income and the assets that we purchased to produce income, that was where it got exciting and really kind of divorced time from money. So I love teaching people how to buy cash flowing assets. I know you're a huge proponent of that, with the Cashflow Ninja podcast. And, I've had you on my podcast, The Lifestyle Investor, and actually we're having you on right after this again, because I want to get your take on a few things too. But I love assets that produce income, because every month or every quarter you get paid, the deal becomes less risky. You're de-risking it every single, installment or distribution that happens. And so for me, I got started in mobile home parks. Then I transitioned to a bunch of different real estate asset classes. Then I transitioned to different businesses where I was just an investor, not an operator. Got into private credit. And now really I try to model what I do in terms of investing the way that the single family offices do. So, for your listeners that are unaware, the wealthiest people in the world, let's say specifically the US, they've got a team that basically runs everything. It's an internal team. It runs their investments, their legal, their tax, everything. And they pay considerable amount of capital to have this in-house. And then I love studying the data from these groups to know exactly what they're doing, because the wealthiest people know a heck of a lot more than most people. So I just want to model my portfolio after them. And that's really been a huge key to the success that I've had financially, not just with cash flow, but to also compounding wealth and net worth and so on and so forth.
I love it. Family offices, just modeled basically on this Rockefeller model. It's fantastic, and what a space to be studying. So we're definitely going to touch back on that again. Before we do, What is your take on sort of the state of the union of the alternative asset space? What are you seeing with regards to the economy, the markets? I know you're involved in many different asset classes. And then also, what are some of the conversations you're having with investors of what they're seeing in your network?
Yeah, it's interesting. I think you've got people on both sides of the aisle. Some that think it's going to be a soft landing, some that think it's going to be, a bumpy or very turbulent landing or a crash landing. I hear smart people on both sides. The thing that I just try to remember, instead of living in a place of fear and being worried about something happening, it's just buying good quality assets at a fair price, ideally a great price, but at a minimum a fair price. And the right assets will perform well regardless of what season you're in. And if you can get them in a way where you're not, there's some form of cash flow that exists so that you're never in a position where you're forced to sell long term, it should really outperform. So that's the thing. I love cash flow because it de-risks the deal. It allows me to never be in a position where I have to force sell it at an inopportune time. It allows me to not have to make emotional decisions. And I think you're going to find great quality assets. So let's say that the economy crashes and burns. There will be great opportunities for investments. But let's say the economy just continues to hum along, which it's done. And there are, some of the smartest people out there. We just had spent some time, here with the Fundstrat founder Tom Lee, and he's been very accurate in his predictions and feels like things are going to really take off and be strong. But you have other people that that think maybe that's not the case. Regardless, I think even in a great economy, you're going to find awesome deals. You just have to be really selective, ideally find deals that are off market so there's less competition, and run the numbers, do your homework, know that it is in fact a good deal based on the facts and based on the data, based on the math, not based on emotions.
I love Dan Sullivan with Strategic Coach exercise the DOS, right? Dangers, opportunities, and strengths. Because once you recognize the dangers, you start to see the opportunities, because they both, crisis is opportunity, right?
That's right.
And Chinese. So what I always talk about is what threats and dangers are there that investors have to be aware of. What are you seeing in this during this time period as far as dangers and threats that investors have to be cognizant about?
Well, there's a number of them. One of them would be, fads. What is a fad? What seems like it's really popular today that's going to continue on for a long time that may not. So, we've even seen this in the fitness industry where there's a lot of shifts to what is, booming and what's great and what's doing well, whether it be a franchise or big box, small box, gym, whatever. And you see it in a lot of different industries. So that's one of them. Another one is leverage. A lot of people used way too much leverage. And so we're going to see opportunities from an investment standpoint. And I've already seen them. We've already invested in some of these deals where they didn't properly allocate funds. Interest rates changed really came as a surprise and hurt a lot of people. So leverage, I think, is a big one. A third one is even just some of these notes that are coming due. So let's say that leverage is fine and it's not an issue. You've got a bunch of these notes coming due on low interest that are going to have to be refinanced on a pretty high interest rate. And maybe in some of these cases, it's 2 times or 3 times or maybe even 4 times greater than, what they had something tied up under, So those 3 right there, I think, are pretty significant. I also think that you're just going to see that a lot of businesses that maybe people thought were maybe more recession proof than they are, those are going to emerge. I think we're also going to see, and we've already seen that there's been a lot of down rounds. There's probably more down rounds on a lot of these privately held companies that are struggling to raise money. And so that's kind of been a risk for a lot of people, that the company's not worth what the last round raised at would put them at for valuation. So, I mean, there's tons of risks out there, tons of things that can go wrong. I think that there's a lot of ways that we can be the beneficiaries of that, and there could be good in it, but there's danger, and there's a lot of groups that, they're doing extra capital calls. They're having to bring in, new financial partners. They're, having to close down their business. I mean, this is pretty readily available across the board, a lot of industries. So it's out there.
We're in another election cycle. It feels like you're hopping from one to another, right? And it just never stops. But yeah, regardless, we're in another one. I feel like the one of the major conversations that is absolutely not happening from either side is the financial state which the United States finds itself in regarding the debt, unfunded liabilities, and then, of course, the tax conversation, because it seems like there's quite a significant difference between the two sides of how they will approach taxes moving forward. What's your take on just the financial state of the United States, and not just the U.S., it's the entire world.
Well,
But
I've
we're
got
in the U.S., so the U.S., and then regarding the taxes.
Yeah, I've got to tell you, I'm really disappointed that our national debt isn't a conversation at any of these debates. It's not part of anyone's talking points. It just seems very fiscally irresponsible to not be addressing this, to address other issues. There are a lot of important issues, but this needs to be one of them. And it's not that we have to leave another issue out. We just need to include this. So yeah, I mean, I think depending on which president wins, there's going to be impact to that. I think, it's really fascinating in an election year what happens. I mean, generally, like we're going to see some. I suspect, like right now, we're seeing a lot of stuff pump because of the interest rate, the projected interest rate cut, and based on when this is being recorded, we're going to see more tomorrow. But what I will say is, depending on who's elected, it's going to create probably some different outcomes, and so that is going to be important to certain people, and knowing tax implications, knowing even just if someone's going to be more pro-business or more pro-government. I mean, all these things need to be factored into investing, and I think we're going to see a little bit of a dip here over the next couple of months. And then regardless of who's elected, we're probably going to see some sort of a pump to the public markets, right? Those are a lot more volatile. The private markets are, a little bit more sound and don't fluctuate as much. And, I don't think we're going to see a lot of movement in the short term in those.
Yeah, as far as from just an overall tax strategy standpoint, if you're an investor, as far as taxes and legal entities protecting what you have and then operating as an investor environment, these are one of the most important conversations to have. It reminds me of that meme of the two older fish in the fishbowl and these two younger fish swimming past them. And the two older fish look at the two younger fish and say, "How's the water?" And the two younger fish say to each other, "What's water?" So it's almost like you don't know, you're operating in water, which is their environment. I feel like sometimes investors overlook that because we've already got significant things that I'm seeing in my world happening with regards to taxes that are sunsetting.
Yes.
And estate taxes changing
Yes.
massively and radically January 1st, 2026.
That's right.
And now, of course, both parties have very different approaches to taxes. And politicians usually, regardless on what side of the aisle they're at, they usually have two things that they do. They either create a lot more currency units, leading to more inflation to pay for things, or they're raising taxes. And I mean, they're promising on both sides are just promising the world to everybody. So they're going to have to do one of the two things and maybe both, right? So inflation plays into this heavily too. So again, these are threats that as an investor, if you position yourself correctly, you can be the beneficiary of this, the environment changing with taxes, and then of course, inflation holding real assets that generate income for you every single month, right?
Yeah. And keep in mind that inflation is a byproduct of printing more money, right? So it is important to recognize that as the monetary supply expands, so do asset values. So if you are sitting in cash, you're losing purchasing power. Your money is becoming weaker. It's becoming less. If you are sitting in assets, you're going to be doing a lot better. But I think a lot of people confuse inflation with, the CPI, and a lot of people think, oh, because we're down to 2.6, we're in good shape. That to me is not the strongest indicator of where inflation is. This is it's handpicked by, handpicked economists by the government that they're going to have different, products in this basket of things that kind of fit the criteria and throw things out that don't fit the criteria to get them to a lower, you know, I guess what people would assume is inflation. And I think the better way to look at it is to look at monetary inflation. Like, think about the money that was printed. So if we can look at that as a function of the expansion of M2 money, the M2 money supply, like that's a better indicator of where inflation is. And over the last 10 years, it's really been even with S&P 500 index. So I think people are maybe feeling like, oh, great, inflation's down to 2.6%, when most people would say it's probably higher, like 13%.
My new book, Get Wealthy for Sure, the #1 financial strategy for business owners to multiply wealth predictably, just hit #1 on Amazon. So Get Wealthy for Sure is an Amazon #1 bestseller. In this book, you'll learn the wealth building secrets that the ultra rich have used for over 170 years. You'll learn how to create your own banking system using a dividend paying whole life insurance policy, allowing you to finance your business growth, invest in lucrative opportunities, and build generational wealth, all tax free and protected from market volatility. You'll also learn the proven strategies used by icons like Walt Disney, the Rockefellers, and top CEOs to grow their empires and get wealthy for sure. You'll learn how to build a team of expert financial professionals, implement tax-efficient strategies, and protect your assets from creditors. You'll also learn the power of thinking like the wealthy and aligning your capital for maximum impact, so you can take control of your financial destiny. I also share a step-by-step aligned capital strategy that will guide you to a life of certainty, clarity, and predictability without falling victim to misinformation or settling for the status quo. If you want to get a free copy of my book, Get Wealthy for Sure, and only pay the shipping and handling, you could go to getwealthyforsure.com. That's getwealthyforsure.com. No, I've seen the numbers, and I've also seen like these AI bots that are scraping the internet and prices. It's fascinating the stuff that they've come up with. And I mean, like, we've seen there's a membership or a subscription service called trueflation.org that even has it at around, from 2020 to 2024, around 25-26% compounded. Yeah. And then you had Shadow Stats, which you're mentioning, is around 13-14%. Yep. So it's interesting to see. I think the average person and even investors that go out and about can see that it is not as presented, and it is a pretty significant thing to keep your eye on.
Yeah, well, keep in mind, like when I said the CPI, that's the Consumer Price Index. And so the two most used components or aspects that should be included in that are not, which is food and energy, because those two have so much inflation that they don't want to use those in their formula. So it's just not a real indicator. I mean, it's an indicator, but it's not the most accurate indicator. And I think for most investors, like if you're just in the S&P 500, you're not making money. You're just not losing money.
Yeah, and of course that's the indicator used as a inflation kind of like escalator for other benefits, right?
That's right.
So if you're the government and you're on the hook for paying people benefits, and you're like, well, I don't know if we can throw 14 to as high as 26% on top of what we're already paying them. We're broke. So how do we keep it as low as possible to pay out as little benefits tied to this escalator, right?
That's right.
Yeah. You've recently had a live event, which you do a ton of live events. You've got a great mastermind along with your book and your podcast and so forth. The Lifestyle Investor Live, which folks had. What were some of your biggest takeaways there? What were some of the conversations, and what were just some of the things that just inspired you there?
Well, we had a blast getting our members together, and generally, for the lifestyle investor events, like these are mastermind member only events. And then every now and again, we might open up 10, maybe 15 seats max to new potential members that have been screened, interviewed, are a right fit for our community to kind of give them a taste and see if it may work out. We have a wait list for that community. We've been at 125 members for, I don't know, about five plus years. And so we're always looking for great people, but for a long time, we've just not really been adding anyone. And so we've got a few spots that we're going to be filling that we're looking forward to. But at the event, it was just a blast getting time with people, getting to know one another. We had, a few really cool things that we did. We had a tax specialist join us so that we can get into, what's staying, what's going, what's right around the corner, what are strategies that we can use right now. We had a real estate panel of some of the most successful sponsors out there, one of which basically works with the biggest name family offices out there. So the consumer products that most people consume are some of their clients. Some of the cars that are out there are some of their family office clients, the owners of those, and some of the technology that people use, some of the tech companies, e-commerce, you name it. I mean, these guys are kind of the who's who. And so it was great getting their update and what they're bullish on and what they say to look out for. But I think probably the most impactful thing that we did that day is we created a roadmap to passive income for all the different types of people who are there. So we did this. We've got probably 20% of our members that are really highly paid W-2 earners. They're professionals. Maybe they're C-suite executives or doctors or attorneys, or maybe like highly compensated salespeople. And so one of our categories was W-2 to business owner, or W-2 to lifestyle investor. We did another category that was business owner, based on a modest income, becoming a lifestyle investor. And then the third one was a business owner that had an exit and how to become a lifestyle investor. Meaning your expenses are covered by your passive income, and ideally more so. It's lifestyle that you eventually want to get to, right? And even ideal lifestyle. So that was really excited for that community. It was just an exciting time. And we launched our foundations group, which is our young adults program, right after that. So that was first ever. I'm really proud of that group and the people that were there. And I'm excited to be able to teach, those that are, in their 20s, 30s, how to kind of take the next step.
Now, in your book, The Lifestyle Investor, you just released an updated edition, right?
Yes.
And one of the commandments that you share in the book, which is very important right now, is reduce the risk. And in this environment, and as people can probably surmise from our discussion, there's a lot of risk to be aware of, but there's also a lot of opportunity. Over the past 12 to 18 months in the alternative asset world, we've seen obviously people get hurt financially. And there's some lessons to be learned from that. And you've had experiences too, where, you saw what was going on, and you even shared, that you were part of a process of going through this process. What can you share of as far as reducing the risk, and from your experiences to what you just witnessed? How can folks, I would say, perform better due diligence, vet sponsors and operators better, and just overall just vet the deals that they're investing in better too?
Yeah, this is such a great question. It's kind of a series of questions, and I have so many thoughts around this, MC. So, first and foremost, most people don't vet their deals very well. They don't know how to vet. They don't know how to vet sponsors. They invest because it feels good, or they like the group, or their friend's investing, and their friend knows more than they do. And these are all poor reasons to invest. I think people need to come up with their own investment criteria. We teach that right out of the gates, having your own page, your own sheet that has, questions as to, answer yes or no, or positively or negatively on whether you would do an investment. For us, we spend anywhere from $200,000 to $300,000 a year for our mastermind community, for our lifestyle investors, to help them vet these deals. But we don't want them to rely on us. We want to teach them the process along the way. So I think that's first and foremost. Secondly, I think it's really important that we model after these really successful family offices. And I'm going to say a single family office is a billionaire family office. So they have figured out the wealth game better than anyone else. And if you pay attention, I mean, I read all the data. I pay for and subscribe to a lot of things that gives me access to data that is really hard to come by. And so I always read like JP Morgan's, private client asset allocation family office report. I always read, same thing for UBS and for Goldman Sachs, and other groups like KKR put these out as well. And then there's family office groups that put them out. But what I think is important for your audience to know is that in the category of wealthy people, the majority of their net worth is in alternative investments. Wall Street calls them alternative because they want you to think that this is what you do after you invest in the stock market. But the reality is the wealthiest families, and if you look at UBS's report, it's 59%. If you look at any of the reports out there, it's anywhere from 45 to 59% of the net worth of the wealthiest families in the US are in alternative investments. What is that? That's real estate, that's private equity, that's private credit, and a few other uncorrelated, investment sectors. But those are the main ones. And so I think most people don't realize that. And my goal is to help teach people what it looks like. So I want people, A, to have discovery on like, what does your asset allocation look like today? And then B, here are what the wealthiest people do. Is there anything you want to do in shifting your allocation? Because most people want to maximize every single dollar and get the highest return. That's not what the wealthiest people do. They will put, 15 to 25% in the stock market, and 20 to 30% in private equity, and 15 to 25% in real estate, and 5 to 15% in private credit, 5 to 15% in cash, 5 to 15% in fixed income, and then maybe 1% in Bitcoin, 1% in commodities, 1% in infrastructure, 1% in precious metals, 1% in, agriculture, right? Oil and gas. And so that's really like what a nice portfolio looks like, because that is going to perform well no matter what the economic season is. And then third thing that I'll bring up to answer the last part of your question is any investor is going to lose money at some point in time. The goal is not to lose money, but we can't fool ourselves. The best education is going to come from a deal gone bad. We don't want it to happen, but I'm telling you, when things are going great, it's really hard to learn the lessons. When things go bad, that's when you can learn a lot. And I'm so much better of an investor today because I've lost money. Now, I don't lose as much today as I used to, and I'm always trying to get better. But there are bad actors everywhere. And then there's just random economies, like shifts in the market that can have a negative impact on things done. But I think it's important to really diligence deals. I think it's important to have the right asset allocation for you, for where you want to go, for your risk profile, modeled after the wealthiest families. And I think it's important that that you get yourself in the game, you learn the lessons, you follow really smart people, and recognize it's okay to lose. It's okay. Like I learned, I make all kinds of mistakes, but the goal is that I don't make the same mistake twice.
In any investment world, whether it's the Wall Street world or the alternative asset investing world, you're going to, I mean, you can lose money in both worlds, right? There are bad
That's right.
actors in both worlds. And we've had a lot of people that got hurt, financially hurt during the great financial crisis, 2008, 2009, that then looked for alternatives because they got burnt and they found the alternative asset investing world, right? And started investing at around 2011, 2012. And then we had that run with a slight hiccup in March of 2020, but straight through to the interest rate spike, Q3, Q4 of 2022. And then all of a sudden, I mean, if you think about it, that was 10 years for one heck of a run.
That's right.
So, and things just don't go up in a straight line. You have these cycles. And yeah, of course, I mean, every single investment space, you have the ability to lose some or all of your capital. So folks have to be cognizant of that. And I love that you share that you model what you study from these family offices and single family offices and look at their portfolio allocation. What do you, any comment on that?
Yeah, one thing I'll say, MC, is that what worked for the last 10 years, that bull market, is likely not going to work for this market that we're in today. And so I think as investors, we need to be really cognizant of the fact that we need to be upping our game, upping our education, getting around people that have a great track record. And if you notice that they have a great track record, you're going to see that they are able to pivot their investment thesis over that time. And so, during that bull run, it was about 11 years, maybe even closer to 12 years. Okay. A huge bull run, probably closer to 11 years. Everyone looked like a genius. Everyone's deals, most people's deals were working out and like even poor practices, poor strategies were rewarded great. And so the problem is then the conditioning of that behavior was replicated for future deals. And then eventually when the market turned, interest rates went up, everything changed. And what did work stopped working, and deals that people were in now are going to blow up. And so I missed out on a whole bunch of incredible deals because I wasn't willing to compromise my investment criteria. But now I'm I'm okay missing out on a great deal, but I'm in a position now where I don't have any of my deals that are going to blow up because I didn't invest in anything that was short-term, floating rates, bridge debt. Like I really was strategic and intentional about finding fixed debt, long-term, having low leverage, like all these things that are important to me that, during the bull market, it didn't matter if people did that or not. But now that we're outside of it, it most certainly matters. And it's going to sink a lot of people.
A lot of people at the FOMO, right? Fear of missing out. And I always say, you got to have JOMO sometimes, right? Joy of missing out. If it doesn't fit your criteria, then it doesn't fit it. It doesn't matter, like, as you shared early on, if your friends are investing in it or it looks cool or the marketing is great, you gotta stick to your guns and to your criteria.
That's
as
right.
as an investor.
That's
What are
right.
you seeing with regards to cash and moving into cash? You see the news headlines every quarter almost with Warren Buffett selling off some more Bank of America shares. He has to submit a trading plan, of course, because he can move markets aggressively if he just dumps everything. So I love how the media position it sometimes. Oh, he's dumping stocks. I'm like, no, those guys have to submit trading plans. It's a slow liquidation over quarters. But what are you seeing in the family office world and with big investors building up a war chest for a potential shopping spree later?
Yeah, I think we got to be careful not to read into things too much when we don't have full understanding. I like taking these data points. I think, Buffett moving into cash is a data point. What does it mean? I don't know that any of us are really going to know that. I mean, maybe there's a bunch of insurance claims that have to be paid out because of the last hurricane, but maybe, he sees something that we don't and he wants to sit in cash. So it's hard to know for sure, but it's a data point that's worth recognizing. And then if you compound that with family offices sitting in more cash now than what is typical, I mean, you can just compare the reports from 21 to 22 to 23. And the 23 reports just came out, a couple months ago. They usually come out in June, May, June. And so, you can see that just based on the allocations that cash is up. And then you compound that with the fact that central banks are really bolstering their inventory of gold. And this is central banks, not just in the US, all around the world. And so, I look at those three things and for me, I'm like, okay, if they're aggressively pursuing a stronger cash position, it might make sense for me to do the same thing. I don't have all the data they have. I don't know all the things that they know, but it rarely hurts you to be in a 5 to 15% cash position, especially if you have a game plan for what to do with that cash. And like I said before, I'm not trying to optimize every aspect of my portfolio. I'm okay sitting in cash. And when I say sitting in cash, like treasuries are still paying 4 to 5%. So you're still getting the best return on your money for sitting in cash of the last few decades, So it's not a bad gig. And I would encourage people to kind of look at that and always at a minimum, at least have 6 to 12 months of emergency funds that you're sitting in cash on. So if anything happens, you've got runway, to be able to figure out what to do to solve and keep your family in a good position.
If you've been watching the news headlines, you know that the world's top CEOs, biggest investors, family offices, ultra affluent, and political elite are all moving to cash. Why? They're building up their war chest to go buy assets at a significant discount in the coming months. They are warehousing their capital in vehicles that have stood the test of time for 170 years with institutions that have made good on their promises for 170 years. If you're interested to learn how to build your own banking system using the infinite banking concept, just like all of these parties, you can watch a presentation at yourownbankingsystem.com. That's yourownbankingsystem.com.
That's a great point. We share the exact same philosophy, 6 to 12 months. And when you're trying to de-risk, obviously heavier towards the 12 months or even more, having conversations with investors that went all in and then had deals blowing up. They sure wish that they had some of those capital that was allocated to all these deals sitting in some cash, earning, even if it's a conservative return, because on savings like bonds or even life insurance, it's there for capital preservation. That's the strategy. That's part of that overall portfolio. It's not to generate a massive return for you. That's more of your investment part of it. So absolutely. So you could see a little bit of de-risking there. Another commandment that I wanted to share in your book, Finding Invisible Deals. And the reason why I wanted to bring that up is that in times like we're at right now, and you're de-risking, some folks are moving into cash, good and great deals are still out there, harder to find. This is where the professionals come in. And then you can also create deals, see what other people cannot see. Can you share a little bit more about that?
Yeah, and real quick, just to put a bow on the last topic of having a proper cash position, I also think it's really important that everyone establishes lines of credit now when they don't need them, because when you do need them, the banks aren't going to give them to you. So that's just another way to have some liquidity in case there's an opportunity that came up, or in case you need to float a deal or float expenses. And so I always like to have, a handful of lines of credit. So just wanted to throw that in. I think that's an important point. To answer your question on invisible deals, to me, these are the best deals. And so when I talked about this commandment in my book, and by the way, I added a ton of content even to this commandment in the new updated and expanded edition that just came out. I updated all kinds, there's tax info and there's all kinds of stuff. But what I want people to recognize is that when a deal is off market, the bidding war for that investment doesn't exist, or it exists at a much smaller clip. And so I like to invest in deals that don't have the competition, that don't drive the price up. I like, offering deals to people that have things that are not even on the market to see if they may, want to sell it or may want to, have some sort of a transaction, because I would rather just negotiate directly with them without anyone else negotiating in the deal. I just think it creates a better situation for me as an investor. And then the other thing that I like with invisible deals is just paying attention to the trends. I have had a lot of success in my career because I have paid attention to trends. I have invested in things that were early, that weren't, full blown, everyone knew about it. They weren't general consensus yet. So for example, I got into mobile home parks super early when people told me I was crazy for investing in this asset class. I got into single family home rentals early before it was officially an asset class, right? It was the great financial recession that actually created an opportunity for institutional money to come in and buy up all these homes in bulk. And that's what created the actual formal asset class that never existed, before 2012. And so to be early in on that, to be early in on an investment in, or even starting a company that serviced those single family homeowners. And I mean, I could go on and on with even, I've been investing in AI for over a decade now. I've been investing in robotics for over a decade now. So I know these are like hot topics today and really cool. I've been investing in tech companies and technology for, probably closer to 15 years now. So it's great to be on the cutting edge of things, but I love to time it early on. And one of the trends that we're about to see, we're already starting to see it a little bit, is the greatest wealth transfer in the history of the world. That, the analysts are speculating, confidently speculating, are going to be somewhere between 80 trillion and $100 trillion that passes from baby boomers to millennials. And so there is going to be, over the next 10 to 20 years, this is massive. This is a massive, like, take the net worth of China, for example. That's 75 or 76 trillion. So we're talking they're the second wealthiest country in the world. So to that magnitude, we're having a wealth transfer that's likely greater than that. That to me screams that there are trends we should be paying attention to. If millennials are going to have that kind of money, we should know what millennials like to do. We should know how they like to work, how they like to shop, how they like to eat, how they like to sleep, how they like to, recreate. Like all these things, there are so many indicators for what, might be, not mainstream yet, but mainstream in 5 years.
What are some of the other kind of like sleepers that you see? I'll throw out one too that I'm starting to see more and more of. Data centers. And you have investors like Kevin O'Leary, Mr. Wonderful, as he calls himself, saying it out loud, which is, he was very passionate about a topic, and he said, I'm raising all this capital to build all of these data centers. And I mean, the logic is, again, to your point, is there a lot of data now? Yes. Will there be more data next year than this year? Yes. Will there be more data in 5 years, 10 years, 15, 20? Of course. You're going to need data centers to manage all of that. What are some of the other things that you're seeing, and maybe your take on that too?
Yeah, I mean, data centers for sure are in that topic of conversation. I would say Bitcoin. I still, there's more, I would say, institutional interest today than there ever has been, but we're hardly, scratching the surface of what the institutional involvement is going to be in the future. So that one to me is a big one. I think recession-proof businesses, like small mom and pop type of businesses in home services, is going to be huge. I think industrial is going to continue to boom as e-commerce continues to grow. I think that we're going to see a lot more real estate that thrives in border towns, specifically border towns with Mexico, since they have now officially become our largest trade partner. So, the real estate supporting multifamily, the real estate supporting industrial around those border towns, port cities, as we do more trade with Mexico once again, and really just internationally, we've got several ports on either coast. And I think all these opportunities, I mean, one of the new industries it's like kind of like a subcategory of industrial, which is it's industrial outdoor storage, IOS.
Interesting.
That is taking off, and I've gotten into a bunch of those deals, and it's kind of like the not as sexy, not as nice part of industrial that has great use for truck storage and tractor storage and I mean, the boats and campers and, just the list goes on and on, where you don't have to have anything nice and fancy. You can sit outside. You've got a nice wall. You've got good security. It's, this is a handful. I mean, I could go on and on and on, but that's a good handful that I think we're going to see a lot of opportunity in.
Absolutely. And the updated edition of the Lifestyle Investor, you mentioned you share some tax strategy, wealth multiplication strategies. What are some of the things that you're covering there that you could share with folks?
Yeah, I mean, really, I'm adding about almost 25% more content to this book, from the last book. So part of it was an update on the deals, which I think is fun to kind of look at that and, how those worked out and all the interesting things that take place. Whereas, almost every deal worked out, but we've got, a deal that has a little hair on it. And so, what did that look like? And how were we able to get our hooks in that, since we had, really good collateral? So it's neat seeing a deal that didn't go as planned, but, still were protected. I got into a lot more detail on net worth, on multiplying income, on tax strategy, on estate planning. I have all kinds of free downloadable resources to all that. And then one of the fun ones is I wasn't able to talk a lot about the Ponzi scheme that I invested in. It's a bummer to lose money. Every investor is going to do it. It never feels good, but I actually wasn't legally allowed to share any of the details. But last summer, I spent time in court as a key witness, as a first day witness in that case, because I had all the info. I'm pretty detail oriented when it comes to my due diligence. So I had all kinds of stuff that the federal agents wanted and the federal prosecutors wanted to use in this court case. But I got to sit, right there in the courtroom, take the stand, and kind of walk through that whole process. So I was able to tell the whole story without having to hide anything like I had to before. I just wasn't able to share a bunch of the details. So it was cool to share that whole story. And really, that's where Murphy's Law for the lifestyle investor came to be. And it's all the lessons I learned because of losing money and investing in a deal that didn't work out. And as bad of a deal and a feeling and an experience as that was, I actually think it's the best thing that ever happened to me, because I have become such a better investor, and I've tightened my investment criteria, and I've just become so much stronger in my investment thesis because of that negative outcome.
That's a great insight, because there's a lot of folks that, there were other Ponzi schemes in the alternative asset investing space, and there's lessons to be learned from that from all investors, right? Don't lose the lesson. And again, tighten up your criteria of how you're going to do diligence and vet, sponsors, operators, deals, and so forth, and know what you're doing, why you're doing it, and what that's supposed to be doing for you. So there's a lot of, it's hard lessons,
That's right.
It sucks. I don't know
That's
how
right.
else to say it. It really does suck, but some of the money is lost. Don't lose the lesson and the experience. And this will make you a better investor moving forward.
That's right. And because of our tax code, there are creative ways that we can take those losses to offset our gains to actually not be as painful as what it could be. We had some insurance companies that had to pony up on some stuff, and some banks. And so it wasn't a total loss. We got some money back. With the write-offs, we're able to kind of accelerate the way that you're able to offset that even versus your active income, depending on how your estate is formed. So there's a lot of ways and a lot of strategies where you can take that bad situation and make it a much better situation. But, it never feels good to lose money ever. So you have to learn the lesson.
Where can folks follow you? Where can they get in touch, stay informed of all the many projects that you're involved with? And what are some of the other cool things that they should be aware that you're involved with?
Yeah, I mean, everything that we do is on the Lifestyle Investor website, so lifestyleinvestor.com. And this is anything from, I've got a laundry list of things. So let's talk about the online course. We have several different master classes, a mobile home park master class, a tax strategy master class. That one's a no-brainer. We've got a deal vetting master class. And we've got a bunch of other content on there, from blog to podcast to book to mastermind, wait list application, so on and so forth. So everything's there. But what I'd love to offer to your audience, and this is, this didn't even exist. We didn't even do this last time I was on the show, but we have a team that does these strategy sessions, these consultations, and generally it's $500 a session. What I'd love to do for your community is offer them for free for anyone that wants to learn more about what we do, wants to learn more about next steps. So if you go to lifestyleinvestor.com/consultation, we can link a free coupon or a discount code so that you can get that at no cost. But it's a pretty powerful walkthrough of how to get from point A to point B and what the exact next steps may be for you.
Awesome. That discount code, everything will be in the show notes. And and I'll also, if you're listening to this, because I got a lot of people listening that quickly wants to look it up, what I'll do is I'll also put it at cashflowninja.com/lifestyle investor. So much appreciated. So much. I thank you so much for coming on the show again, Justin. This is always great to have these conversations with you. Thank you so much for always providing so much value for all my listeners and my viewers.
Oh, my pleasure, MC. Great to connect. I love the questions you ask and just the general, format and thought process that you have. You're really great as a podcast host, and I hope your audience, your listeners, really appreciate that. And yeah, just love what you do. Love what you're about. Love the general thesis. I'm a huge fan.
Thank you.
This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.